Well, hi everyone, Shaun Humphries here. Welcome to this edition of All Things Retirement. In this video, we're going to cover off a really important component to retirement income planning, and that's retirement cash flow and understanding how much is enough. It doesn't sound like a very exciting topic, but it's probably one of the most important topics that we need to consider when we look at developing our retirement income plan, but also living our retirement income plan, because if we don't get it right, it could really jeopardize our long-term income security. So before we go into the discussion on cash flow planning, let's just look at a model. So when we look at retirement income planning, when we sit down with people, we don't view it as just looking at their retirement investments or their cash flow. It's multifaceted. You know, how do you look at your purpose for your retirement years, the cultivation of health so you can enjoy the nest egg you've built up, establishing goals and working towards them, understanding how pensions integrate with your retirement income plan, your investments, how they need to be structured to produce the income to supplement the pensions. It could be tax planning to reduce the tax that you pay, and obviously estate planning, which kind of flows into the whole discussion of legacy. These are all the components that should be looked at in the context of our plan. So how much after-tax income is needed? Well, it goes back to our model. You know, if I want legacy at the end of the day, that's going to impact how I spend my money. If I want to live with a sense of purpose and pursue hobbies and opportunities and giving back to my community, that has a cash flow cost often attached to it. So it really comes down to your specific goals. There's no such thing as a rule of thumb in this area, contrary to what a lot of financial magazines would have you believe. So you need to know your numbers. Your numbers are going to be very specific. No one has numbers just like yours. So the first question I'd ask you is, do you understand your own after-tax cash flow needs? What are the specific numbers that you have to have every single month, every single year to achieve your goals? I talked about rules of thumb. I think they're ridiculous. One of the ones we hear about is you need 70% of your pre-retirement income when you retire. I don't know where that number comes from. And a lot of the modeling, because it's specific, you have to look at your own philosophical approach to retirement. So I'll have some people that go, listen, Shaun, I want to have retirement income just like my paycheck. You know, the money came in, I budgeted for holidays and experiences and paying for the bills, and then I want that income, you know, adjusted for inflation every year, that it's very predictable, and that goes from between now and life expectancy. I'll have other areas, you know, where clients will say, listen, Shaun, when I retire at 60, I think the first 15 years of my retirement, I'm going to have lots of energy. That's when I want to do my traveling. I want to actually spend more and put more pressure on my portfolio in the first 15 years, and then just make sure I have enough, you know, from age 75 on to look after the basic expenses. Well, those two philosophies look very different in the real world in terms of how you actually plan. So it's really important you look at your individual needs. So I want to give you a quick example, and this might give you some guidance on how to look at it in your situation. It's very practical. And it may seem simplistic, but a lot of times people get lost around this topic. You know, again, how much do I need, Shaun? Well, that depends. So this couple had a net income of $5,000 per month coming in. So after deductions for pensions and group benefits and taxes, and they were getting $5,000 a month. Now, we asked them to take a look at what expenses will they not likely have when they retire. So the ones they came up with, the mortgage is going to be gone, that $600 a month, that'll be gone. We won't be making RSP contributions anymore because now we're retired. Stock purchase program we won't be involved in anymore, and we'll take off the parking costs. So there's $1,300 a month of expenses that won't be there. So their basic need is $5,000, what they get now, less that $1,300 of expenses that they won't have when they retire. So they know they're going to need, at a minimum, $3,700 per month. Now, that number might need to be higher, but they know that's the baseline number they need to plan for. So we'll use then that number to create a base case scenario in their plan and to see whether their pensions and investments and other sources of income will allow them to accomplish that. And we will inflation adjust that. So we'll take the $3,700 a month, and then every year we'll increase it with a cost of living adjustment. Now, in addition to that, they need to be clear on their non-discretionary, discretionary numbers. So we encourage clients at least 5 years before retirement, every once in a while, track expenses. Get a sense for what are the discretionary, non-discretionary. The discretionary are those expenses that they have discretion over. It could be travel expenses, helping the grandchildren, hobbies, you know, memberships at the club. In non-discretionary, again, if you go back to that previous slide, would probably be that $3,700 a month. So those are non-discretionary, your utility bills, your food costs, those basic expenses that never going to go away. Property taxes as an example. And so you want to understand the difference between those two. And the reason why is non-discretionary need to be funded by sources of income that are guaranteed, don't fluctuate, are very predictable, because you don't want any surprises around the cash flow that looks after those expenses. Discretionary expenses you've got a little bit of flexibility with, right? So whether it's travel, helping grandchildren, maybe some years you do it, some years you don't. Now the reason for that is if you're funding any of those expenses out of your portfolio, and let's say you've got a balanced portfolio that maybe one year doesn't do as well as you'd like, maybe you turn off the tap on that portfolio for a short period of time until it reconstitutes itself. Then you go back in and you keep doing the gifting you want to do. So the non-discretionary allows for a certain level of flexibility. The other thing is understand the difference between periodic and non-periodic expenses. So non-periodic, so those are expenses that come up not every month, but every once in a while. And again, it could be property taxes, depending on how you pay those. It could be certain kinds of insurance payments, as an example. It could be club dues. It could even be travel expenses. So when you look at your budget, you want to make sure that you build a plan to accommodate those expenses if they're not a monthly kind of expense that comes up. It's really critical because that actually ties into your portfolio, your cash accounts, money that needs to be at the ready to look after the non-periodic expenses. So really critical thing. So what I would encourage you to do if you're getting close to retirement, begin kind of looking at your expense numbers a little bit. For many people, the money comes in, money goes out, they're saving money to RSPs, they're making the TFSA contributions, they've paid down debt, they're living a comfortable lifestyle. They're not thinking about it too much. But as you get closer to retirement, you want to make sure you drill down into those numbers so you understand again what your after-tax income need is, what the difference is between the discretionary and non-discretionary, your periodic and your non-periodic. We do this kind of coaching all the time for clients. We think this is a fundamental piece to a successful retirement income plan. And if you're beginning to look seriously at this area, you may want to consider retirement income planning coaching. We've walked hundreds of families through pre-retirement, transitioning into retirement, and then being successfully retired. And so one of the things we walk people through is a game plan process to identify whether there are any gaps in their plan, whether they're tracking in the right direction, and if they're not, to provide them with some ideas about how they can make sure that they have confidence and peace of mind about their retirement. So if you'd like to start a conversation, don't hesitate to reach out to our office. The contact information is below. So all the best in your retirement income planning.